Hey there folks, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today I want to talk to you about a tax-exempt trust which could be great for appreciated assets. Mostly that's real estate. Why? Because you've depreciated over time and you have to repay the taxes on that, called depreciation recapture, and the capital gains. Let me explain how it works. If you bought a property for $300,000 that's now over the span of 10, 20, 30 years worth $3 million, you might have depreciated that $300,000 to $100,000. Which means if you go to sell that property today, you're going to pay over $1 million in taxes between federal and state, which is why a lot of people do a 1031 exchange into another property. Well, you may not want to be a landlord in retirement. So what to do? What you could do is do a tax-exempt trust to take that property and put it into the tax-exempt trust and sell it and pay no taxes. Little to no taxes. Sounds like a great deal, right? Could make a lot of sense for you. And the way it works is you say on day one, you're going to utilize 90% of that $30 million and live off that for your life. That could be roughly $150,000 to $180,000 a year. Now, why did I say 150 to 180? I'll tell you in just a minute. It's based on your life expectancy, and the IRS says what you're legally allowed to pull out to liquidate the whole thing. Let's say, God willing, you live until 100 years old and you eat away at more at the principal, whatever's remaining goes to a charity. Here's how it works, folks. Your money goes 2 out of 3 places. You choose. So right now, if you get paid, it goes to you. Or the IRS, we know that because our paychecks get reduced, and or charity. Your job is to choose 2 of the 3. Here you're choosing charity over the IRS. So in this case, and this could be for your heirs too, this is a great estate planning technique to take money out of your estate as well. And you're able to liquidate and live off to 90% of the income of the asset that you put into it. Now, because you said on day one that 10% of the $3 million is earmarked for charity, you get a $300,000 write-off on day one, right? 10% of the $3 million you put in. So you get to write off $300,000 on day one. With that, you can do a Roth conversion of $300,000 and play it net neutral, nothing in taxes. This could be huge for you guys. Now, I know what you're thinking. Well, I just donated a $3 million property to charity and I lived off all the growth and money in there, but now my heirs have nothing. What you could do is buy a life insurance policy on it for $3 million. For someone who's 65 years old, that might cost $30,000 a year, which is why I said $180,000. You only clear $150 because the other $30,000 you're going to pay towards insurance premiums. It's one of the few times I say it may be okay to do an insurance product like a permanent policy or a last die policy because it helps fulfill the inheritance if that's important to you. Folks, there's a lot of different ways you can save money on taxes. If you have any questions on this, please feel free to reach out to myself or anyone of our team below. Look forward to helping.